Hey guys, David Robinson here. Welcome to the Lead Sponsor Podcast. We've got another great episode for you today. I'm joined by Rob Beardsley of Lone Star Capital. Rob is a very impressive young sponsor who got into the business around 2018, 2019 and started Lone Star Capital, which is based out of Houston, Texas. They focus generally on the Houston, Texas market, although they are starting to expand their business slightly. They've acquired $350 million of real estate. They've gone full cycle on two of those deals and currently have about $300 million in assets under management. They also have integrated property management. And he is a young man who has done some very impressive things. He has when he first got into the business, he went as far as building his own underwriting model, which is used widely across the industry at this point. It's been downloaded, I believe, 10,000 times. And he also wrote a companion book to the model, The Definitive Guide to Underwriting Multifamily Acquisitions. We've actually had Rob on the show in the past over a year ago, and we talked about that model and talked about his book. And he's gone as far as writing a new book, Structuring and Raising Debt and Equity for Real Estate, which we dive into today, which is a very impressive book. The way that Rob writes is great for someone who's in the space and very familiar with concepts, but maybe isn't extremely experienced and doesn't have a lot of operational experience in structuring debt and raising equity for their deals. And so he goes through and gives a very concise and informative explanation of a lot of high-level concepts, and also gets into the weeds a bit and talks about some of the technical aspects of debt and equity. And so we get into his book a little bit today. We talk about his background, his mindset, being a young sponsor, a young up-and-coming sponsor who has done some impressive things, and how his mindset plays into his ambition and what he's trying to accomplish with his business. And so I'm really excited about the conversation that we had with Rob today. He's an impressive young man, and I know you'll learn a lot from this episode. So without further ado, Mr. Rob Beardsley. All right, Rob Beardsley, welcome to the Lead Sponsor Podcast. Appreciate you coming on.
Thanks for having me back on.
So as I mentioned in the intro, we've had you on in the past, over a year ago now. Great conversation, but we didn't dive into a lot of your background. And I'm intrigued personally by you being a fairly young guy, and the amount of progress that you've made in a very short period of time, and also taking on some pretty big challenges. You've built out your own underwriting model. You have written a book that coincides with that model, The Definitive Guide to Underwriting Multifamily Acquisitions. You've also written a new book, Structuring and Raising Debt and Equity for Real Estate. You started a private equity company. You dropped out of, well, I don't want to give away all the story because I want to dig into it a little bit. But look, man, you're young and you've gotten after it over the last handful of years. And I want to dive into the mindset. But before we dive into the mindset of things, I want to go back and just talk a little bit about your upbringing in what that looked like and what led you to get into the real estate space. I know you have a family background in real estate, so let's start there.
Yeah. So my parents ran a residential brokerage firm in Silicon Valley. They bought and sold luxury homes with their clients, and then on the side they did some fix and flips and some development on the single family side as well. So I was around real estate from a very young age, but wasn't particularly drawn to it. I played sports and got good grades in school and everything, so I was ambitious and I worked hard, but I wasn't necessarily all about real estate. And ended up going to college for computer science, and my parents pushed me in that direction because we grew up in Silicon Valley, and they said, well, the big bucks are made in tech. That's what you should go do. And that was what I thought I would do. I always had this entrepreneurial spirit and thought that I would maybe join a startup or start my own startup or something like that, and do something more entrepreneurial. But while I was in college, I was doing my own research about how to make money in the stock market, how to make money in real estate and things like that. And I came across multifamily, and that really resonated with me. And the business model made a lot of sense because it's really not that difficult to go from understanding one single family home economics to scaling it up to 100 units plus. So that I felt like it was a very short learning curve for me, and was able to lean on my parents' background and network and things like that to be able to jump in rather quickly. And that's what gave me the confidence, as you mentioned, to shortly after meeting my business partner, we hadn't officially started the company yet, but we did put our first deal under contract together. And that was what gave me the push to say, you know what, I'm going to leave school. He's going to quit his job, and we're going to focus on this full time. And thankfully, so far, we haven't looked back.
I want to go back to how you met your business partner, and how that relationship came about. And what was it? I'll let you describe his background and how the relationship came about, and then I'll have a few follow-up questions. So let's start there.
Yeah, so my business partner, he was formerly trained as a tax attorney. He was at MetLife for 12 years. He worked on MetLife's private equity transactions from a tax perspective. So he was peripherally, or somewhat connected to private equity and real estate deals. And he had friends also that were in the business. So he, similar to me, kind of had this pull and ambition to do something more entrepreneurial and get involved in real estate. And we actually met at a real estate conference through a mentorship group. So people are shocked when they hear that. I don't know if there's any necessarily good way to meet a partner. I'm sure there's better ways, but from what I've heard and understand, partnering is one of the biggest risks that you take, whether it's a marriage or a business partnership, right? And that's kind of the most important thing that you need to get right. And so thankfully, maybe on accident, I don't know, we've gotten it very right. We have a very complementary personalities, complementary skill sets. And even though we are different in age and different in disposition in many ways, we've never had an argument, and things just click. We always agree on everything. And but that doesn't mean we're just, I don't know, yes men to each other, right?
Sure.
It's a very good relationship that has allowed us to lean on each other to grow faster than we could on our own, right? Because when you're starting, you lack confidence in yourself, because why would you have confidence in yourself, right? You haven't proven yourself to anyone or yourself. And so yeah, and especially in those early times, having someone to lean on is really, really important.
Did you attempt to put together partnerships prior to you and Kent getting together? I'm wondering, because it's, there's a lot of sponsors out there that would love to find a partner, right? And they would love to sort of go down this path that you've gone down, and maybe they have false starts, in the sense of they find a partner, they think it's going to work, they start to go down that path, and they have to retract and move forward again. Did it just work out? The first one happened to be just the right fit, or did you attempt other partnerships prior to that?
Yeah, very, very nearly so that it worked out. The couple wrinkles, which I've actually never talked about this before, is when we originally got together and got started, the plan that my dream, the dream originally was my dad and I are going to start this business together, right? My dad has been huge in my life, awesome, great role model, gave me so much. And so that was the dream. Unfortunately, so we kind of got into it as my dad, me, and Kent. And unfortunately, or fortunately, I don't know, he was just too busy, and he was still running his brokerage firm. And so he wasn't really able to contribute. And so then we kind of made the decision, okay, it's just Kent and I now. And, he was fine with it. It was amicable. And that's kind of how we proceeded. So it was really pretty much, aside from that wrinkle, just Kent and I from the start, and then let's go. We did, however, bump into future issues where we partnered with, another person that was a property management firm that came our way. And that was very messy, very unfortunate, and kind of scarred us a bit, which, as you know, pushed us towards vertically integrating and really keeping more control over the deals and the operations and more transparency and everything like that. Uh, yeah, it's a healthy reminder that, maybe on a day-to-day basis, you don't feel like you are, doing anything major by having operations in-house, but it kind of protects you, hopefully, at least from bigger issues, which I'm not going to get into
Sure.
today about that.
So this is interesting because I actually didn't know the backstory about how Lone Star Capital started. Great to hear. And for those of you listening that are seeking out partners, it can happen on the first time. So get out there, be networking, be connecting with like-minded individuals, and look for those opportunities and be open for those opportunities. Let's push forward a little bit and let's talk about what you guys have accomplished thus far. So if I am correct, you formally started Lone Star in 2018, 2019?
Yeah, early 2018.
Okay. And you're from Silicon Valley. You have based your business with an emphasis on Texas, really emphasizing the Houston market and now surrounding markets. But you're also out in New York. So talk to us about that dynamic and how you went from being in Silicon Valley to focusing on Texas, but also basing your business out of New York.
Yeah, so the focus on Texas was kind of a no-brainer. There's a lot of good markets everywhere, but when Kent and I started, we started working with a mentor who was very active in Texas, and we felt that there was a big opportunity there and a lot of capital that wanted to be there. So we set our sights there first, and then once we got our first couple of deals done, which were in Houston, it pushed us to keep our focus. Focus is one of our main tenets that we focus on, because focus helps us have better deal flow, have better relationships that leads to better deal flow, get awarded deals. It also lets us be more of an expert in the market rather than looking at a bunch of markets and not really knowing them too well. Being an expert in one market is a big advantage from that perspective. And then from an operation standpoint, focus lets us be vertically integrated, right? It simply wouldn't be possible to have all of our management in-house if we had deals in, Kansas City and Phoenix and Tampa, right? It just wouldn't work. So focus is big for us. And so what I always tell people, it's less important it is important which market you pick. Obviously, some markets are better than others, but there's plenty of good ones out there. So it's just important that you actually do pick one and plant your flag rather than try to jump to the hottest, latest trend every 6 months.
Yeah. Well, and it attracts capital, right? I think that as passive investors out there are looking for sponsors to work with, having someone that has geographic specialization is powerful. You have some sponsors and teams that are in multiple markets all across the country, and nothing wrong with that. There's definitely some very successful companies that have focused on a larger footprint geographically. But when there is someone who specializes in a pretty narrow geographic region, it does give them a unique competitive advantage in that market. And so that's appealing to a lot of passive investors. So to date, you've acquired $350 million of real estate. You currently have roughly $300 million in assets under management. You've gone full cycle on 2 deals and still active in the market. Let's talk briefly about what gives a young guy who decides to dive into the real estate world the confidence to be able to go and tackle your first book, which was the definitive guide to underwriting multifamily acquisitions. What goes on in a young man's head to give him the confidence to go and tackle something like that and give it up to a world of very sophisticated business professionals?
So it really goes all the way back to the very beginning, where when this goes way back before Lone Star, where uh, like I said, originally my dad and I were looking at deals together in California, and I was underwriting deals in California. Obviously, none of them were making sense. And back then, I was looking for an underwriting model, and my dad said, "Well, you should build your own." And at the time, I didn't agree with that. I thought, well, why would I recreate the wheel? There's plenty of good models online. Let me just download one that I like and use that. So for whatever reason, he felt that it would be best to build his own. He kind of has a background in that as well. He used to be a trader as well, and so he built models and algorithms and all sorts of stuff. So he used to be an Excel guy, and that's probably partially where I got it from. I mean, I've always been fascinated with numbers and stuff like that. So that's been fun. So he pushed me to build the model, which turned out to be the best thing ever, because building a model teaches you a ton about modeling and understanding the business. If you know how to put everything together, right, you actually understand it at a deeper level. So that was very pedagogical. But then also building the model turned out to be very helpful from a kind of branding standpoint. And I made what turned out to be a very good decision. And it wasn't like I had this master plan, but I'll explain the thought process. So the decision was give the model away for free. And a lot of people were selling, a lot of people do sell their model. And a lot of people were pushing me to sell my model as well, saying, hey, you can make a lot of money here. The thing that didn't resonate with me about that was, if you're an investor of mine and you're asking me for my underwriting, and I say, no, sorry, I can't, it's for sale, you have to buy it. That doesn't make any sense. Or what also wouldn't make sense is if my model is available for sale, but then at the same time, if an investor asks for the model for the deal, I just give it to them. So it just, in either case, it didn't make sense to me. So I figured, okay, you know what? I could probably get the same or more value, probably way more value, of just giving the model away in the pursuit of building a bigger network, getting our name out there, building brand, establishing credibility, all the things that we talk about when we talk about thought leadership and marketing in this business. So that those steps kind of happened by accident, right? Building the model was, I'd say, kind of by accident, and then giving it away for free, again, wasn't this master plan, but it took off. You know, the model's been downloaded, I don't know, nearly 10,000 times now, and it has built so many relationships. And the crazy part about all of this is, you know, there are models that exist. There's plenty of models out there, but there wasn't really any book or resource or PDF or anything like that that just explained it, you know? And a lot of people, when they would download my model, they'd have questions about it. Rightfully so. It's complicated. You're using a foreign tool, right? So writing the book was this, this idea for me that I had to do it because it didn't exist out there, and it was so complementary to the model that I had put out to the world. So it really felt very natural to make it happen. And it was such an easy book to write, much easier than writing this, the new one, because like I've said before, the table of contents for my first book was just basically going down I just had my model open. And I said, okay, I'm just going to write about every single input I see, every single assumption, output, stress test, everything. So it was like a brain dump from the model to a book, super easy to write. And I enjoyed it. And then, the book has been that first book has been more successful than I had anticipated, which, is awesome, of course. So that again pushed me to write the second book. I had to follow it up, and who knows? I don't know. I'm so far on pace for writing a book every 2 years. We'll see if I can keep that up.
Did you enjoy writing in school? Have you enjoyed writing in the past, or was this a newfound passion? I don't. Maybe it's not a passion. Maybe it's just a necessary evil in your world. But give me your thoughts on that.
Yeah, well, in high school, I graduated nearly at the top of my class and took advanced level courses and got great grades, but I was a horrible writer. My teachers hated my writing. I don't know. I don't know what it was. I worked so hard and I would get a C on a paper. It didn't make any sense. So that was weird. And little bit better in college, but it wasn't a strong suit of mine, nor was it a passion. What started very early on was I started writing a monthly newsletter almost from the very beginning of Lone Star. So at this point, we've published, I don't know, well over 50 newsletters, I'd imagine. And every newsletter is an article, and an article is included. So I've been writing consistently for the business for years now, and that I actually do have some passion for. I do like talking about what I'm seeing in the market, what's going on, certain top, whatever's top of mind. And like Richard Wilson, I've never pulled this off, but Richard Wilson has a really great strategy that he explains. Hey, writing a book's really easy. You have to write articles anyway for your business. So create a table of contents. Let's say the book's 10 chapters, write 10 articles, and that's each chapter, and then turn it into a book, right? So I tried to do that with the second book and tried to write articles that would fit nicely into the book and stuff like that. So yeah, I mean, basically, I'd say the articles have been a passion, but not before that.
So what caused you, and maybe you already alluded to this a little bit, but the new book is Structuring and Raising Debt and Equity for Real Estate. Fantastic book. What I love about the way you write, as both a reader of the articles that come out from Lone Star Capital, as well as both your books, you're just straight to the point and very, and you make what can be extremely complicated concepts very palatable. You make it so the average guy who's wanting to do deals in this space can really get a very good understanding of these concepts without being overwhelmed and confused and frustrated. And so I appreciate that about the way that you write. But this the new book, Structuring and Raising Debt and Equity for Real Estate. What were the biggest challenges you faced in writing this book?
Yeah, no, you said a lot of great things, and I appreciate you pointing out what I believe to be one of my superpowers, which is taking something complex and making it simple. I think that is something that I think I do excel at, which is awesome for you to point out. The second book, like I mentioned earlier, was a lot harder to write because it's much more open-ended. I mean, this is at the end of the day embarrassingly short, but that's my style. Most books out there can be cut in half for sure, at least. And but like I said, it's an open-ended topic. You could talk a lot about debt and equity, have different structures and things like that. So I had to be kind of pick my battles and figure out what I wanted to talk about. Also, to your point about the simple thing and the regular guy getting involved and wanting to do deals, the biggest complaint that I do get actually about both of the books is that they are for the absolute beginner, there a lot of concepts or terminology is over their head, and I'll take that. I'll take that. That's probably if I'm going to get some criticism, I would say that's the best criticism because that's just my style. I maybe even struggle to break things down to the very basics because that's again not where my passion is. I like diving into the weeds. I like talking high level. So I'm writing kind of in a way for me as well. So for a lot of people, that's great. For some people, it's like, hey, you might need to spend some time Googling first and doing some other research. But yeah, I mean, hopefully that gives some insight as far as kind of the writing mind.
So let's dive into just a couple of the concepts in the book. You start off with an intro to debt, talking about loan products and structuring debt. At a very high level, what if there are maybe one or two concepts that are included in the book around structuring debt that you could maybe highlight for someone who's listening right now that may be interested in picking up your book?
Yeah, so on the debt side, the most interesting thing about debt is the fact that it is the greatest source of risk in real estate. And unfortunately, we often take it for granted. And this past year's experience has shined a light on that. But the main takeaway I would say is just because you can't see the risk doesn't mean it's there. So it's important to know how to understand how debt is actually affecting the deal and the risk profile. And more specifically, understanding and having the skill set to structure the debt such that it matches the business plan as well as the investor's goals, right? And it doesn't have to be super complicated, right? Just at a high level, if you want to hold long term, you might want to structure the debt such that you can hold long term. On the flip side, if you want to be opportunistic and be able to sell when you want, then you probably want to bake into your debt structure some optionality there, so you're not bogged down with a very restrictive prepayment penalty. So those are simple concepts, but it does get more complicated when you start looking at a menu of debt quotes and different ways that you can take the deal. So at a high level, those are kind of the things that you want to be striving for, is how do we optimize the debt for our business plan and for our goals, and it's not necessarily plugging in the debt terms and seeing what spits out the highest return. Because again, the model doesn't really show risk, it just shows return. And so you need to look under the hood a little bit and figure out, okay, is this extra little bit of return worth it? Or am I taking on onerous terms that, have downsides that aren't right in my face?
And lingering on the concept of debt, since we're recording the beginning of January 2023, the market's been turned on its head with rising inflation, which led to a dramatically increase in interest rates. How has your perspective of debt changed based upon your experience over the last 12 months? And what have you changed in your business, if anything, moving forward into 2023 and 2024 as it relates to debt?
Yeah, a lot. So while I would have loved to learn from others' mistakes and, through theory, right? You learn best going through it. So we've all gone through it in the past year. We've seen an unprecedented rise in interest rates that was, even more importantly, non-consensus, right? It's one thing for rates to move. It's another thing for the market to be wrong, right? We all had projections in our models that said X, and then Y turned out to be the case. And it was a very big difference. And so the biggest thing that it taught me is not that, for example, if you had floating rate debt, you saw your interest expense go up dramatically, right? So you could say, oh, well, floating rate debt is evil. And, I would say that that's maybe true, maybe not. I would say the biggest thing that I learned actually is the fact that whether you think the optimal debt structure from a financial standpoint is floating or fixed or short or long or what have you, a big component that I kind of failed to factor in is the investor experience. And I have to understand that we're not just striving to provide investors the highest returns. We're striving to provide them the best experience. And limiting variability provides a better experience. So even if our models or our strategy says that, hey, we should float on this in this situation, that may actually not be the best investor experience because we have to deal with greater volatility. So in the end, you may actually come out ahead, because actually, if you look at historical data, floating over almost any period of time has been cheaper, right? So you could say, well, floating rate debt is better, but it creates these issues. And then if you have a kind of a unprecedented event like what we've experienced in terms of the Fed raising rates, then you have issues, and then you have more things to deal with on investor relations side of things. So that bogs us down. And yeah, the biggest thing that it taught me is that we need to be focusing on building a smooth business that provides a smooth experience for investors. Investing is risky and difficult. So instead of striving to provide the absolute highest returns for investors, we need to make them feel the most confidence and comfort in investing. That's really my new kind of paradigm shift.
And does that translate well with institutional equity? Or is that mainly focused on, what we would call more, mom and pop type equity. What are your thoughts on that?
Yeah, that's actually been an interesting observation as well. To answer your question, I think it does more so relate to retail investors. Uh, Institutional investors have been, for example, in our portfolio, they've been very understanding of issues. If our rates have risen and we have to pause distributions, for example, they don't have a problem. They're saying, "Oh, you guys are great. Let's do more deals." Right. Whereas a retail investor is going, "Oh, I don't know, this is not going well. This is bad. Maybe you guys are bad." Right. And so that's been an interesting juxtaposition to look at. Hey, you have some rich guy in Florida write you a $500,000 check, and he's saying, "Yeah, no, you guys are the best. Let's do more deals," even though the deal that person is in is maybe not performing to plan. Right. Well, the world is not to plan at the moment, so that's been an interesting experience. So yes, those insights are more so for the retail investor, which we haven't really talked about this, but in our business, we focus a lot on retail and institutional, which I think is a bit unique about us, but also a competitive advantage because we get a lot of good feedback, and we push ourselves to improve for the institutional investors. They give us good insights, good feedback, and they make us operate at a more professional level. And then we take all that and apply it to the way that we interact with our retail investors. And that I don't see that changing. It's not like we're trying to use retail investors as a stepping stone to get to the big boys. I like both business models, and I think there's a place for them together moving forward. So it puts you in a difficult position. I'll end on this because a lot of the way that you would communicate to both, they're kind of at odds with each other, right? You have to be good. You have to be able to explain it this way and then that way, and position yourself to hopefully appeal to both, right? If you just focused on one, you'd probably do a bit better. But again, I feel strongly about working with both.
Yeah. So you alluded and you touched on this slightly in that conversation, but anything new that you would do moving forward in 2023 as it relates to your mindset around debt, or 2023, 2024 for that matter, that has sort of changed about your approach? And obviously you alluded to, making decisions that aren't just about the highest return, but really taking into account the investor experience. Anything else that you could maybe share with the listeners that could be beneficial to them as they explore debt moving into 2023, 2024?
Yeah. So what's been really great about this experience is it's forced everyone to take less leverage in one form or another, whether on a very simple level, agency debt. Agency debt is constrained to a certain debt service coverage ratio, and there's pretty much nothing you can do about it. And so that forces you to be at a lower leverage when the spread there is tighter. But if you rewind a year ago, everyone was really focusing on bridge loans because bridge loans were really cheap. I mean, they were pretty much as cheap as a fixed or as a permanent loan, but you were getting a lot more incremental leverage. So on a weighted cost of capital basis, bridge loans were way cheap. So everyone was doing bridge loans. However, my mindset shift is I don't know if we'll ever go back to borrowing to those levels because, again, it makes the returns look better, but the risk that you can't see, it's not quite worth it, I don't think, to squeeze it to that level, right? So the small percentage of return that you're taking away from the deal by reducing leverage, you get back a lot of certainty, a lot of cushion, and things like that. So, we'll see as the market goes. I'm sure, the market's going to open up again and we're going to have a wide open capital market. But I don't know. I don't think we'll go back to borrowing to those levels again. I just don't think it's worth it, like we've discussed, from the return standpoint and from an investor experience standpoint.
Love it. So let's move on and just high level discussion around the equity side. Any pieces of your book that you feel like stand out as like, hey, I crushed it when I wrote that piece? Is there anything in there that stands out as like on the equity side? Yeah, for someone that maybe is in the business but doesn't have a full grasp of the equity side, this is the piece for them. Anything that stand out to you?
I think there's some chapters on the equity side as far as the different sources of capital and different structures that go along with it. And when I refer to different structures, you've got your retail LPs, and that's raising money $100,000 at a time. You have co-GPs, you have fund of funds, then you kind of go to family offices and private equity. So I kind of run someone through that spectrum and lay out what you can expect at every level as far as who you're dealing with, the terms that you can expect, the structure, and kind of where you need to be or how you need to position yourself for each level. So I don't really think there's a lot of people out there talking about this kind of stuff catered towards the sponsor that wants to understand the menu of options as it comes to capital. And I think it's a great way for someone to get exposure to the different options out there to see what resonates with them. The big thing that when I'm on stage, I often talk about institutional capital because a lot of people have, I would say, preconceived notions or misperceptions about institutional capital and thinking that it's not for them or that that's not an option. But, in reality, it is an option. And there's a lot of people doing deals with sponsors. Even, I heard the other day, I think they're a $2 billion private equity firm here in New York. And they said that they did like a sponsor second deal. And we had a private equity firm do our second deal. It's possible. So I like to talk about that and give people that option and kind of disabuse them of certain notions that institutional capital is, cutthroat, ruthless, or not worth it, what have you.
Is there a particular type of capital that you prefer to work with? I know you've already said that you like, the idea of working with both institutional as well as retail, but you also alluded to a couple other channels such as co-GP, LP. So there's a variety there. Is there any particular type of capital that you lean into and you would prefer to work with more than others?
Yeah, I would say co-GP is our sweet spot. It's actually, if you think about it, a really good blend of both worlds because you are working with people who are professional and they're sophisticated, but they're also in the retail world. So it's a mix of both. It's a good source of capital, and it's not an all or nothing type of situation. Whereas when you're dealing with, let's say, a private equity firm, they either want 80 to 90% of your equity check or nothing. And that puts a lot of risk because, we've had situations where someone signed up to do 90% of the equity and then they disappeared. Right. And that's I would say that's not common, but it's a risk. It can happen. And even with signed term sheets and everything, right? It's a risk. So with co-GPs, you are taking less concentration risk like that, and it makes your deal more flexible. So we've leaned in heavily on that. That's been great. I would say our goal would be to scale with our co-GPs, so that way a co-GP partner and us are doing $1 million, $2 million, $5 million raises together, so that way we can scale together. That's the goal.
Yeah, love it. All right, well, the book is Structuring and Raising Debt for Equity. I'll get that. Structuring and Raising Debt and Equity for Real Estate. It's available. I have the Kindle version. You obviously have the hard copy. Is it also available on Audible?
I'm working on it. Yeah.
Okay.
I actually just finished the Audible for the first book, and I voiced it myself. And then I am going to get the audio done for this new book, hopefully in this month.
Cool. That's great. So if you haven't picked up a copy of either of Rob's books yet, the Definitive Guide to Underwriting Multifamily Acquisitions, as well as structuring and raising debt and equity for real estate. Go down into the show notes right now, click on one of those links, and you can go grab a copy of his book. Before I let you go, Rob, I want to do just sort of a round of maybe knee-jerk gut reaction answers to a few questions. The first is, tell us about a moment in your business where you thought it might all fail.
So our second deal was, in a weird way, even harder to raise than the first one. And we were just really struggling. We were asking the seller for extensions, begging for extensions. It was just tough. It was really tough. It was a good deal, but it was a little bit unique. It wasn't kind of your typical value add. The value was really in the management. So we were going to investors saying, yeah, we're from New York, but we're really good managers and we're going to turn this deal around. That obviously was a hard story to sell. And we tried and tried and tried. And we kept putting up more money with the seller at risk. And eventually I got to a point where I felt that I had truly given it my all. I thought that I had tried and tried, and I gave up and I accepted it. I told everyone, hey, it's okay. Let's lose this money. Let the seller take it and we'll just start over. I don't know what we're going to do, but we'll start over, and kind of gave up. And kind of, I don't know, a few days later, I got a phone call back, and we were able to get a family office to invest and put the deal together, and it worked out. It was awesome. And it was, I mean, so many lessons to learn along the way as far as failure. And, it wasn't good that I gave up, but, I guess I came back a bit. But the other really cool thing was our partner in that deal, when they came back around, because I had already asked them to invest many times, and they just said, no, no, no. And for whatever reason on that final go, the deal appealed to them. But the really cool thing about that partnership was when they came into the deal, they said, hey, listen, we know that we could come in here and rip your heart out, and we could get whatever terms we want from you. But we're not going to do that because we want to build a long-term relationship. And that was a really cool experience, a really good lesson about business and how to, this is coming from someone who's been in the business, 50,000 units later, and has seen a thing or two. So I really appreciated that. And that was a great takeaway.
Tell us about the biggest win you've had in your business so far.
Biggest win we've had so far. I would say our biggest win has been the relationships that we've built. And, most specifically, we have our biggest partner is a family office here in New York. And I love this story. It's, I don't even know how, well, so I met one of the sons at an event where I happened to be doing a presentation. And somehow must have gotten their email or something, and they were on my email list for years, getting my emails, getting my deal pitches. I'd say, hey, are you interested? Are you interested? No response. And, then one day I just get a phone call back and saying, hey, I've been ignoring your emails for years. Let's talk. And from there, we built an amazing relationship. It's much more than just a capital relationship. It's a true partnership. And yeah, they're our by far our biggest investor. So that's our biggest win.
Love it. All right, last question for you. What question would you want me to ask my next guest? Keeping in mind that almost all of our guests have, our lead sponsors out there making deals happen. They generally have acquired at least $100 million in real estate, in commercial real estate.
Well, this is, much more down at the ground level and not as inspirational, but I would be curious to understand, as we've been growing our business, there's all these hiring decisions and all these different ways that you could organize the business. So I'd be curious as to get under the hood and get an understanding of how everyone's structuring their business from a human, a human capital standpoint, from a infrastructure standpoint. How are they looking at deals, and how are they organizing their people to be as productive as possible? So that would be really interesting conversations to have, actually.
Love it. Got it down. All right, Rob. Hey, this has been a great conversation. I'll say, in my experience in working with you and your team, it's been a fantastic experience. You guys are exceptionally disciplined. You communicate extremely effectively, and it's been a pleasure doing business with you in the past. I'm excited for your book and the value that it's bringing to a lot of people out there. So again, if you haven't picked up a copy of either one of his books, go down into the show notes, click on one of those links, and you'll get it there. Outside of the books, Rob, what's the best way for people to connect with you and learn more about what you have going on?
You can learn more about what we have going on at Lone Star Capital on our website. That's lscre.com. If you want to hear more from me, connect with me on LinkedIn. I post every day on LinkedIn, and you can shoot me a DM over there. Happy to connect.
Awesome. Thanks, Rob. Appreciate you coming on. Look forward to staying in touch.